If you've ever wished there was an account that lets you put money in before tax, grow it tax-free, and then take it out tax-free for something you're guaranteed to spend money on, there is. It is the Health Savings Account, the HSA, and in 2025 it is still the only account in the US with that triple tax advantage. Used well, it's one of the most powerful tools an everyday investor has. Let's get clear on what an HSA is. It's a personal account you own, not your employer. You put money in, you can invest it, and you can spend it on qualified medical expenses. The tax treatment is special. Contributions go in pre-tax through payroll, or are tax-deductible if you fund it yourself. The money grows without being taxed, and when you withdraw for qualified medical expenses, you owe no tax at all. That's 3 separate wins. Who can use one in 2025? You must be covered by an HSA-eligible high-deductible health plan, an HDHP. For 2025, an HDHP means a plan with at least a $1,650 deductible for self-only coverage or $3,300 for a family, and a maximum out-of-pocket limit no higher than $8,300 for self-only or $16,600 for a family. You also can't be covered by any non-HDHP medical plan, can't be enrolled in Medicare, and can't be claimed as someone else's dependent. If you meet those tests, you're eligible. How much can you contribute in 2025? The limit is $4,300 if you have self-only HDHP coverage and $8,550 if you have family HDHP coverage. If you're 55 or older, you can add a $1,000 catch-up. Employer money counts toward those limits, so if your company chips in, you can contribute the rest up to the cap. If you switch plans mid-year, your limit usually prorates by the months you're eligible, but there is a last month rule that lets someone eligible on December 1st contribute as if they were eligible all year. Just know there's a 12-month testing period afterward where you need to remain eligible, or the extra amount becomes taxable with a penalty. The triple tax break is the headline, but the flexibility is what makes HSAs special. Withdrawals are tax-free for qualified medical expenses for you, your spouse, and your dependents. That includes doctor and hospital bills, prescriptions, most dental and vision costs, and a long list in IRS Publication 502. Premiums are mostly not eligible, but there are important exceptions. COBRA premiums, certain long-term care premiums up to annual limits, and after age 65, the premiums for Medicare Part B, Part D, and Medicare Advantage can be reimbursed. Medigap premiums are not eligible. Before age 65, a non-qualified withdrawal is taxed as ordinary income and hit with a 20% penalty. After 65, the penalty goes away. You'd pay ordinary income tax if the money isn't used for qualified medical expenses, which makes the HSA behave like a traditional IRA for non-medical spending. That penalty change is why many people treat the HSA like a stealth retirement account for health costs in their 60s and beyond. Strategy now. If you can afford it, the most powerful way to use an HSA is to invest the money and let it compound for many years, then reimburse yourself later. Pay today's small medical bills from cash, keep your receipts, and let the HSA stay invested. There is no time limit on reimbursements as long as the expense was incurred after you opened the HSA and you keep good documentation. That shoebox strategy turns the HSA into a tax-free compounding engine earmarked for future health costs you are almost certain to have. To see why this matters, imagine you invest $3,000 a year inside your HSA for 20 years and you earn an 8% average return. That's roughly $137,000 tax-free that can be used on healthcare in your 60s and 70s. Many retirees face 6-figure lifetime medical costs even with Medicare. Building a dedicated, tax-free pool for those bills is one of the most practical moves you can make. A few very practical details make or break results. First, fees. Some HSA providers layer account fees, investment fees, and cash thresholds you must keep idle before you're allowed to invest. Read the fine print. If your workplace HSA is expensive, you can leave enough for current year spending and periodically roll the excess to a low-cost HSA custodian you choose. Trustee-to-trustee transfers are unlimited. Rollovers you handle yourself are allowed once every 12 months. Second, investing policy. Treat the HSA like any other long-term portfolio. Choose low-cost, broadly diversified index funds. Keep a small cash buffer in the HSA for true deductibles or near-term bills if you prefer, then invest the rest according to your time horizon and risk tolerance. Because qualified withdrawals are tax-free, every fraction of a percent shaved off fees and turnover goes straight into your future care. Third, coordination with other benefits. If your employer offers a flexible spending account, the General Purpose Healthcare FSA is not compatible with HSA eligibility, but a limited purpose FSA that covers only dental and vision is allowed. A dependent care FSA is separate and doesn't interfere. If both spouses are covered by an HSA-eligible family plan, the family limit applies across the household. Each spouse who is 55 or older can make their own $1,000 catch-up, but it must go into each person's own HSA. Fourth, taxes at the state level. HSAs are federally tax-favored, but a few states, notably California and New Jersey, do not conform. In those states, contributions and growth may be taxed on the state return, even though they're tax-free federally. This doesn't erase the federal benefit, but you should understand your state's treatment. Fifth, record keeping. If you're using the shoebox strategy, keep digital copies of every eligible receipt dated after your HSA was opened. Label them clearly. 10 years from now, when you want to reimburse yourself for a roof-high medical bill or simply harvest tax-free cash for prior expenses, you'll be glad you kept meticulous records. Where does an HSA fit in the overall order of saving? A simple hierarchy works for most people. First, take every dollar of free employer match in your 401k. Second, fund the HSA up to the level you can realistically invest for the long term, ideally the full annual limit if health costs are manageable. Third, use a Roth IRA if you qualify, or continue in your 401k if you don't. After that, go back to the 401k or a taxable brokerage account. The exact order can shift with your marginal tax rate and plan options, but the HSA's triple tax break earns it a high slot on the priority list. A quick word about using HSA dollars today versus later. If cash flow is tight, there's nothing wrong with using the HSA for current medical bills. That's one of its purposes. The key is to be intentional. If you can afford to pay out of pocket now and leave the HSA invested, your future self gets a larger tax-free pile. If you can't, you still get the tax break today and you've protected your budget. Either way, avoid using the HSA for non-medical spending before 65. The 20% penalty is a wealth killer. Let me tie the numbers back to 2025 so you can act. If you have self-only HDHP coverage, the HSA cap is $4,300 this year. With family coverage, it's $8,550. And if you're 55 or older, it's $1,000 more as a catch-up. The HDHP minimum deductibles are $1,650 self-only and $3,300 family, with out-of-pocket maximums up to $8,300 and $16,600 respectively. Your contributions for 2025 can be made up until the tax filing deadline of 2026, so if you're watching this late in the year, you still have time. Employer contributions count toward the cap, and if you lose eligibility mid-year, prorate carefully. People often ask whether an HSA or a Roth IRA should come first. The honest answer is, it depends on your match, your tax bracket, and your health costs. If you get a 401k match, take it. If your employer contributes to your HSA and you can invest most of the account, the triple tax break can edge out a Roth IRA in pure tax value. If you don't have an HDHP or your state taxes HSAs, the Roth might come first. The right answer is the one that lets you save consistently at the lowest all-in cost. There are two more advantages that rarely get airtime. One is portability. Your HSA goes with you if you change jobs or health plans. You can stop contributing when you're not eligible and start again when you are. The account remains yours the whole time. The other is estate planning. If your spouse inherits your HSA, it becomes their HSA. If a non-spouse inherits it, it becomes taxable to them that year, so it's usually best used during your lifetime or by a spouse. Let's close with a practical checklist you can execute this week. Confirm that your health plan is truly HSA eligible and that you meet the other requirements. Set a target contribution for 2025, $4,300 for self-only or $8,550 for family if you can, plus the $1,000 catch-up at 55 and older. Audit your HSA provider's fees. If they're high, plan periodic transfers to a low-cost custodian. Decide how much cash you want to keep in the HSA for near-term bills and invest the rest in a broad, low-fee index fund. Turn on automatic contributions each paycheck. Start saving digital copies of every qualified receipt from the day your HSA opened. And write down your plan so you don't reinvent it every time headlines change. Most people will spend tens of thousands on healthcare and retirement. Some will spend six figures. You can fund that cost with fully taxable dollars, or you can build a tax-free pool over the next decade or two using an HSA. Put money in pre-tax, let it grow without friction, and take it out tax-free for the expenses you know are coming. That's the HSA's promise, and in 2025, it's as strong as ever.